Okay, fun seekers, welcome back to the second presentation regarding financial statements and ratio analysis. One thing I forgot to mention is that you really want to print this puppy out. I mean, you can have it at your disposal, but the formula sheet is something that will help you quite a bit when you do these. Why? Because it has the formula. You can I make it a little smaller. Make it just a little bit smaller. 90%. Has the formula such as earnings per share, and then it shows you net income divided by number of shares outstanding, and it tells you where to find that data. So we did the common stock ratios in our first presentation, and now we're going to finish up with profitability, liquidity, activity, and leverage ratios. So again, real exciting stuff, right? No, it's accounting, but that's okay. We always are in debt to the accountants for giving us this information. So let's start with the profitability ratios. Now, I have a cheat sheet that I made beforehand to make me look smart because I make lots of mistakes. But you never know. You might want to check to make sure I did all the calculations correctly, okay? Because everybody makes mistakes. Yeah, I do. So you should check your work at least 2 or 3 times like I do, because one typographical error on your resume, right, can make you look really bad, and we don't want that, do we? No. So the profitability ratios allow us to measure a firm's returns by relating the profits to sales, the profits to the assets, and the profits to the equity. And these are, some of them are very easy to find on the Infernal Net, but some of them are not that. A couple of them you have to basically do yourself, but they're not hard. None of these are hard, dear students, as we're going to see. None of them are that difficult. So let's take a look at the first of these, and that's the net profit margin, also called the after-tax profit margin. That's the rate of profit being earned from earnings after expenses and taxes. So the net profit margin is equal to the net income divided by the total revenue. The bottom line divided by the top line. And so if we go over to the cheat sheet, not the cheat sheet, but the formula sheet, it shows net income, also called net profit after taxes, divided by total revenue or net sales. The net income is called the bottom line. The total revenue is the top line. And notice it says income statement. Oh, there's a mistake right there. It's supposed to be a little tab key right there. Oh, that's what I got. That fixed that right there. Huh? I love Google Docs. Okay, so I'm not going to refer back to the formula sheet anymore. Make sure you print it out, and you will have it at your disposal. So let's do this. Okay, here's my cheat sheet. Okay, if we found the net income that's on the income statement. Where is it, puppy? Where did it go? Here it is. The net income is the bottom line, 258,856, and we divide that by the top line, the total revenue, total sales, all the money that came through the door, $6.873 billion, 834. I get 3.79. And Yahoo says the same thing. So lots of places give this data. Okay, folks? So you do it. Make sure I did it correctly. I think I did it correctly because Yahoo said that I did it correctly. Now, notice that we said, whoops. The higher the better. It varies greatly from industry to industry. So 3.79, is that good? Is that bad? I don't know. Why? What do we have to do? We've got to compare it to their competitors, the industry they're in, and then we will know whether that's good or not. Now, Sprouts Family Market is in a very competitive world, the grocery stores, but it's sort of off the beaten track, isn't it? Its major competitor, I would say, is Whole Foods, right? Whole Paycheck. But they're owned by Amazon now. So you really can't compare them because Amazon, might give you some information about how Whole Foods is doing, but they're not going to give you all of it like Sprouts has to do. Amazon will wrap it into lots of other departments in their uh, financial statements. So it's a little difficult. We might want to take a look at Krogers and Safeway. Vons owns, those of us who live in the West Coast, Vons is owned by Safeway, and Albertsons and Krogers are somehow, I thought they were already together, but now I think they're working together. And then in other parts of the country, you might have HEB, which is one of the country's largest private companies. And I don't know what the HE stands for, but I know the last B stands for butts. That's the guy's name. So what we need to do is compare it to competitors, but sometimes it's not easy, is it? For a grocery store, I think 4%, 3.7% is pretty darn good because it's such a cutthroat business. The next one is the gross margin. So what we're going to do is we're going to go down to the gross profit, which is after we've taken out all the cost of goods sold. If you go back and take a look at the income statement, you'll see that we started with the total revenue, and then we remove the cost of goods sold, or how much it cost us to buy the stuff that we sold. And then we wind up with the gross profit. So let's run over to the income statement and see, here's the total revenue, the top line, but now we take out the cost of that revenue, cost of goods sold, sometimes it's called, and we wind up with 2.5 billion. So if we do the calculation, we take the 2.5 billion divided by the 6.8 billion, and we get 36.88, which makes a lot of sense, folks. When you walk into a grocery store, some things have very slim margins, but many stores, you got to believe that they're getting the stuff that they're selling you for about 40%, 30% less than what you pay for it. Well, that makes sense, right? They got to pay the rent, they got to pay all the people who work there, they have to make a profit. Plus, they buy a whole lot more. So when they go to Procter & Gamble and say, we want to buy some Pampers, they don't buy, a truckload. They buy dozens of truckloads of Pampers. So they get a much better price. And so we find that it's 36.88. Make sure you get that gross profit divided by the total revenue. And that seems about right. That seems about right for a store. They've got to make a profit. So they're not going to sell to you for pennies less than what they bought it. Sometimes they say, we're selling it at cost. Well, that's because they want to get rid of it. Now, some things like milk that they sell every day, obviously they're not making a 40% markup on that. But some things they make even bigger markups on. Cool? Okay, so let's go back to the, where is it? There it is. Again, higher the better, and it varies greatly from industry to industry. Now, the operating income takes it one step further. We look, instead of the net profit or the gross profit, we look at the gross income, we look at the operating income. So that is the next step down the income statement. So now we took away the cost of goods sold. Now we're taking away all the operating expenses, and we're left with $350 million of operating income. So I divide that by the $6.8 billion, and I get 5.15. And here's where it gets a little strange. I go to Yahoo, and they say it's 4.25, and I'm not sure why. I don't know. But I tend to believe what Sprouts puts into their their financial statements on Edgar. So I'm going to take that at 5.15%, 5.12%. So is that good? Is that bad? Again, it varies greatly. So when we are looking at a specific company, we always need to look at its competitors within the industry. When we find a company that is atypical of its competitors in the industry, it is a signal that we have more investigative work to do. Or maybe it's a signal we need to look at the competitor. Yeah. Peter Lynch, in his book, One Up on Wall Street, said that he often got the best ideas from talking to companies when he asked them questions about their competitors. And they would kind of go, oh, yeah, they're really eating our lunch here in so many words. So you always have to look at the competitors. Now, the next two are going to compare the earnings to the assets and to the equity. So ROA, return on assets, and ROE, return on equity, are two very popular measures. Return on assets look at the amount of resources a company needs to support operations. It reveals how effective the company is in generating profits from the assets that it has available. And of course, the higher the better, and it's a very popular ratio. So if we looked at the formula sheet, or we don't need to, we know that the net income is coming from the income statement. But where are the total assets? Do you remember? Right, they're on the balance sheet. So we remember that net income is what? 258, 856. But now we got to go look at the, where is it? There it is. We got to go look at the balance sheet to find the assets. And the total assets are $3.327 billion. And so if we do that calculation, we get a return on assets of 7.78%. That's what I got. Check that, make sure I did it right. Check it, check. Yahoo says 7.55, so I'm not sure. And it's often you'll get a little different numbers, especially if you see TTM, trailing 12 months. See, we're looking at the year end, which makes sense because we haven't gotten the first quarter of 2024 data yet. And we're not going to get that until mid-April or so. And Yahoo should be looking at the exact same numbers, so I'm not sure why it's different. But oh well, that's what you'll find. That's why, as I said, we like to listen to what Mr. Edgar has to say, Securities and Exchange Commission. Okay, so 7.78% is, it sounds good. We have to compare it to their competitors. But it seems like the company is doing a decent job of returning earnings based on the assets. Now, here's where it gets a little interesting, because return on equity doesn't use the assets. It uses what we own out of those assets, the shareholders' equity. So it's the same formula, except instead of total assets, we use the total shareholders' equity, which is, again, on the balance sheet. So let's take a look at that. That's down below. Come on, sweetheart. Come on. I got to talk nice to my computer or it gets mad at me. $1.148 billion. That's how much of those total assets Starbucks, Sprouts actually owns. Okay, so we have to use that number. And if we divide that number divide the net income by that number, it turns out we get a return on equity of 22.5%. Which, that's quite a bit more than the return on assets. Remember, they have a lot of debt that they have to service, right? Because return on equity uses stockholders' equity instead of the total assets for the denominator, the return on equity is sensitive to the amount of debt a company is carrying. Specifically, if a company carries a great amount of debt, return on equity will be much larger than return on assets. Now, you're going to hear this, especially in the real estate world. You are using other people's money to make your money. Right. You're borrowing money to make your money. Some investors view this positively because they use the debt. They think the company's using the debt as a lever to earn more. Others, your humble instructor included, are worried about the possible negative consequences of too much debt. Now, as we're going to see, and I think I've already told you, Sprouts is not worried about all the debt they loaded up on because they got most of it at a very low interest rate. Hopefully, it's not going to be. Hopefully, it's not floating. It's not a variable rate. Hope they got a fixed rate, because if it is, boy, are they going to be hurting. But we're going to see that no. Sprouts can pay its debts. Thank you very much. So the return on equity is much higher than the return on assets. Now, here is one that you don't often see, but it's very popular with some investors such as Warren Buffett. The problem is there's a few different versions of return on invested capital. So we're going to use the most simplistic version. By using both long-term debt and stockholders' equity, the return on invested capital measures how well a company is managing all the capital the company needs to earn the profits. So you take the net income and you subtract out the dividends because they went out the door, right? They paid those dividends. And then you divide that quantity by the total long-term debt, which has to be serviced, and the total stockholders' equity. So that's invested capital, the debt and the equity. So in this simplistic version, there are a couple others that are a little bit more they're not that much more, but they're a little bit more complicated. We get a return on invested capital of 10%, which again, for a boring company that sells food every day and other groceries, is, I think, pretty darn good in my humble opinion. But again, we have to look at their competitors and try to find some competitors and see what kind of return on assets, return on equity, and return on invested capital those companies are generating. Cool? And folks, the rest of these are going to be very similar. Just finding the two numbers, dividing them, and then deciding whether or not it makes sense to go, well, we have to go look at the competitors, making sense to compare those and see if the numbers are in line, or maybe there's something that's not quite right. We got to do more research. So now we're going to take a look at the liquidity ratios. And these are actually very popular. Certainly the current ratio and the acid test. What a great name, right? The quick ratio, the acid test ratio. These financial ratios are concerned with a firm's ability to meet its day-to-day obligations, operating expenses, and satisfy its short-term obligations as they come due. In other words, can you make payroll? Can you pay the rent? Right, exactly. You have short-term debt payments coming due. And so these look at the current assets and the current liabilities. This is all on the balance sheet. The acid test ratio is basically the same as the current ratio, but what it does is it gets rid of the inventory, and we'll see why. Now, net working capital is our one weirdo. It's actually not a ratio. It's an absolute number, as we'll see. So let's take a look at the current ratio. It's one of the more popular financial measures, and you will see it on most all the free internet websites. You take the current assets and you divide it by the current liabilities. So it's a good indicator of how stable a company is. Anything over 1.0 is considered acceptable. If your current assets equal or exceed your current liabilities, you should be able to satisfy your short-term obligations without any problems. Obviously, the greater the number is, the better. But some of these tech companies with cash coming out of their ears, they have current ratios in the hundreds or thousands because their current liabilities aren't that great. Their biggest liability being the labor, because it costs money to you got to pay the tech people. But other than that, they don't have big plants and equipment like a car company or something like that. So let's take a look at the balance sheet for Sprouts. And we've got to find the current, come on, sweetheart, come on. Like I said, I got to talk nice to my computer or it's going to be mad to me. Current assets of $603 million, current liabilities of $546 million. So right off the bat, we can see their current assets exceed their current liabilities. And that's exactly what we see when we do the calculation. We get 1.104, and Yahoo said 1.1, so basically the same. So is Sprouts able to pay their day-to-day obligations? Yes, they are. They're not having any problems. So that's the current ratio. Anything above 1, looking good. Now, just because it's below 1 doesn't mean it's the end of the world. We have to do more research and understand more about the company. But anything above 1 says, yeah, they can make payroll. Now, here's the weirdie: net working capital. It's actually the current ratio in absolute dollar terms. If the current ratio is greater than 1, then the net working capital will be positive. If the current ratio is less than 1, then the net working capital will be negative. Of course, the higher the number, the better. This statistic is less popular than the current ratio And it's really not a ratio, as we said. It's more, but it's often discussed when discussing the current ratio and liquidity ratios. So in other words, how much cash do you have above and beyond your current liabilities? So it turns out they have another $56.9 or $57 million lying around the store that they can work with. That's the net working capital. If their current assets were less than the current liabilities, it would be a negative number. It doesn't mean it's the end of the world, doesn't mean we should run away. We just have to do more research. And then here is the one with the great name, the acid test ratio. And you see the formula like this, and I think that's really dumb. All you really got to do is take the current assets and subtract the inventory. And this is much easier to calculate. But basically, the acid test ratio says, you know what? Throw away the inventory. We're not interested in it. Now, why would you do that? This ratio measures the ability of the company to meet its short-term obligations, even if its current inventory becomes obsolete or undesirable, and hence difficult or impossible to be turned into cash. You see, Sprouts doesn't really have to worry. I mean, the food's going to sell. It might go bad, but it's going to sell. Many of the packaged goods can last for months, right? The expiration dates. But what about a computer company? Oh boy, you got to believe that they don't want to have inventory lying around the house. No, because computers become obsolete so quickly. In fact, it was Dell back in the 1980s and early 90s that pioneered what was called just-in-time inventory. Right, they didn't even build the computer. I mean, they designed them and they had them ready to build, but they didn't build the computer. I don't know if they've changed this. They didn't build it until you ordered it. Or, a company ordered it to be sold at their store or something like that. So they didn't even have inventory. And this was replicated throughout the industry. And this also was moved to other industries that said, this is really smart. Let's make sure that we don't have parts lying around that we don't really, sometimes we might not need later on. And that was just-in-time manufacturing. And that was also promulgated the global economy and global supply chains, and everything was hunky-dory until COVID came along. And there were 176, I think at one point, there were 176 freighters off the coast of Los Angeles and Long Beach waiting to be unloaded. Yeah, so now you hear nearshoring, moving the manufacturing closer to the places where the items are turned into finished goods. So let's take a look at the quick ratio, the acid test ratio for Sprouts. We take that total current assets and pull out the inventory. And the inventory, well, of course, that's their lifeblood. They got to have stuff to sell. People walk in the door and there's nothing to sell, they're going to be in trouble. So it turns out that you take out the inventory and you only have $280.574, that's what I got on my cheat sheet, $1 million worth of assets. So the the acid test ratio turns out to be about half, 0.513. Make sure you do it because I make mistakes. In other words, oh my goodness, what if Sprouts' inventory all of a sudden became obsolete? It's not going to become obsolete, folks. I mean, people need to eat food. They need groceries. They need diapers. They need, whatever Sprouts is selling. And so it's now, of course, if there's a disaster or something like that, then they have to deal with it. But so Sprouts is not worried about an acid test ratio of 0.513. And I don't think we should be either. Okay, let's continue. Those were you getting the hang of this? I hope. It's pretty straightforward. Once you've done it a few times, it's pretty straightforward. And it creates this wonderful stew that we use and compare to other companies. Let's take a look at the activity ratios. It's also called the efficiency ratios. These are financial ratios that are used to measure how well a firm is managing its assets. So they're called also sometimes turnover. How often are you turning over your accounts receivable? How often are you turning over your inventory? How often are you turning over your total assets? We use data from the balance sheet and the income statement. The activity ratios measure a firm's ability to convert different accounts within their balance sheet into cash or sales. Companies will try to turn their production into cash or sales as fast as possible because this will generally lead to higher revenues. Again, some companies are going to be able to do this a whole lot faster than other companies. It's part of the industry they're in. So the accounts receivable turnover takes the total revenue, the top line number, and divides it by the accounts receivable. Now, if you don't know what accounts receivable are, folks, if you haven't taken accounting, it's very simple. It's money that is owed to us, accounts receivable, money that's coming in the door, 30 days, 60 days, 90 days. The higher the number, the better. It indicates the return a company is getting from its investment in accounts receivable. By maintaining accounts receivable, firms are indirectly extending interest-free loans to their clients. A high ratio implies that the company operates either on a cash basis, which is what we're going to find because most people pay their grocery bills right that day, or its extension of credit on a collection of accounts receivable is efficient. A low ratio implies that the company should reassess its credit policies in order to ensure the timely collection of imparted credit, not earning interest for the firm. Or that might be just how the industry works. I haven't worked in the defense industry in a long, long time. But when I did, this was a major problem. The Congress, this was late 70s, 1970s, early 80s, the Congress was hitting on the Defense Department and say, come on, guys, we want you to do more small companies. We want you to make it easier for small companies to do business with the Defense Department, which makes sense. That makes sense. And so the Defense Department did. They opened up more of the bids and made it easier for smaller companies. But you know what? At that time, my understanding is they're a whole lot better now. Uncle Sam was not very quick in paying his bills. You buy an aircraft carrier, don't worry, we're going to get around and give you the $13 billion, but it's going to take a while. Well, these small companies said, no, you can't do this to us. Come on, we can't absorb these we can't wait 6 months, 9 months, 10 months, a million years to pay us. And so my understanding is the Defense Department is a whole lot quicker in paying their debts now. So let's take a look at the accounts receivable turnover. So we need the total revenue, that's the top line number. Remember, it's 6 point something other billion divided by accounts receivable. So let's go to the balance sheet. Oops. Come on, sweetheart. Cut it out. I'm so bad with this machine. So here's our accounts receivable. It's a very small number compared to the billions of dollars that's coming in the door for Sprouts. So 30 million, 30.313. And if you remember the top line number, let's go back to the income statement. Top line number was 6.8 billion. So we get an accounts receivable turnover of 225, which means every 2 days. Right? Every 2 days, yes, the accounts receivable is turning over. So, Sprouts is not a company that lives and dies by accounts receivable. Most people walk in and pay their grocery bill right away. Now, let's go back to the next one, which is the inventory turnover, right? Is that the next one? Yeah, inventory turnover. And this is going to take a look at how often they turn over the inventory. The higher the number, the less time an item spends in inventory, and the better the return the company is able to earn from funds tied up in inventory. As with all ratios, this ratio must be compared against industry averages. A low turnover implies poor sales and therefore excess inventory. A high ratio implies either strong sales, hooray, or ineffective inventory buying or maintenance. High inventory levels are unhealthy because they represent an investment with a rate of return of 0. And of course, it also opens up the company up to trouble in the case of falling prices or obsolete products. Now, this is the dilemma of car dealerships. You want to have as many cars on the lot to get people into the lot to get them interested, right? But you're not making any money off the cars sitting on the lot, so you want to have as few cars on the lot. So it's one of those dilemmas, those push me, pull you situations. So let's take a look at the inventory for. Remember that total revenue is about 6.8 billion. How much inventory do we have? About 300 or so million. Where is it? Well, that's the income statement. Come back here, Piano. Where's the balance sheet? There's the balance sheet. About $323 million worth of inventory. So they're turning over their inventory about 21 times, 21.155 times a year. So what is that? That's, every couple of weeks, isn't it? Not quite, 52 weeks in a year? Every 2.5, 3 weeks. So you walk into the store and you think, well, everything's hunky-dory. Well, you come in 2 weeks later, 3 weeks later, all the merchandise you're looking at has been turned over. Well, not quite. Some things turn over a lot faster, like milk and eggs and those kind of things. And other things turn over more slowly. But that's the idea. They're turning over that inventory 21 times a year, which is, what you'd expect, right? Is what you'd expect from a company. Some high volume companies might do it even quicker. Some low volume, like the car dealerships, it'll be a little slower. And the last one, where's the last one now, is the total asset turnover. We take the top line number, total revenue, and divide that by the total assets. And if we go to the total, we remember that 6.8 billion or so. We go back to the balance sheet, and the total assets are 3.3 billion. So if we go back to the formula sheet, or back to my cheat sheet, that says about 2 times every 6 months they're turning over the total assets. The total asset turnover ratio measures the firm's efficiency at using assets to support sales and revenue. The higher the number, the better. Companies with low profit margins tend to have high asset turnover. Those with high profit margins tend to have low asset turnover. And again, we would take a look at their competitors and see if that number makes sense. So those are the activity ratios. Now let's take a look at the leverage ratios, which are sometimes called solvency ratios. We are trying to measure the amount of debt being used to support the operations and the ability of the firm to service its debt. So the debt to equity times interest earned, total debt to total assets, and total debt to capitalization. We're going to use data from the balance sheet or the income statement. Now you're going to hear this term, I already mentioned it, leverage. Debt is often referred to as leverage. The idea is that you're using other people's money to make your money. You are using the borrowed money as a lever to increase your earnings. And it's actually, it's in the lexicon. When one, in the language, when one firm buys another firm using borrowed money, it is often referred to as a leveraged buyout. You might have heard of Elon Musk buying Twitter, which he now calls X. He did not use a lot of his own money. He borrowed a lot of that money. Now, I don't know why. He's got plenty of he's got plenty of stock that he could have sold to accomplish the purchase, but that was a leveraged buyout. And again, it's a two-edged sword. That debt can help you make more money, but you got to service that debt. And if you can't service that debt, you're getting hauled off into bankruptcy court. So, as I said, my favorite motto for personal finance is make love, not loans. Now, if you know anything about the real estate world, you know that I'm out to lunch. Debt, borrowing money is just part of the real estate world. It's just so important, and of course, it's important in the corporation world too. That's why we use bonds. That's why we have bonds. So let's take a look at the debt to equity ratio. This one, if you've taken Business 121, Principles of Money Management, used to be called Financial Planning and Money Management, this should look familiar. You take your debt, in this case they look at the long-term debt, and divide it by the total stockholders' equity. It's a measure of a company's financial leverage calculated by dividing long-term debt by shareholders' equity. It indicates what proportion of equity and debt the company is using to finance its assets. A higher debt to equity ratio generally means that the company has been aggressive in financing its growth with debt. This can result in lower earnings, lower reported earnings, right, as a result of the additional interest expense and hence lower taxes, because you get to write off those interest payments. Sometimes investors use the total liabilities instead of the long-term debt. The lower the better for we more risk-averse investors. And so I like to see a low number here. In fact, The industry says it should be less than 100%, but I'd like to see it less than 50%, personally. But that's me. I'm really worried about these things. What we're going to find is that Sprouts isn't. If we take the long-term debt on the balance sheet of $3.399 billion and divide it by the stockholders' equity rate of where is it? 1.148. We get 121.86%. Hi! They owe more than they're worth. But that's not unusual, folks. It's not unusual in the industry now. People have corporations because money was so cheap for so long. They've loaded up on debt, and most of them are very happy. They're paying it off. Thank you very much, and they're not having any problems. But it makes people like me nervous, right? Times interest earned. Now, eventually, dear students, you're going to read The Intelligent Investor. Don't read it as your first book, okay? Read One Up on Wall Street or A Random Walk Down Wall Street. And don't forget to read our textbook, right, for the class. But you're going to want to read that book. And in that book, you're going to see the master at work using financial ratios. That's Mr. Benjamin Graham. And this is one of his most important financial ratios, times interest earned. In other words, this is a measure of the ability of a company to meet its fixed interest payments. So you take that earnings before interest and taxes, and you divide it by your interest expense. Times interest earned is used to determine how frequently interest payments are earned by the company during a year. Obviously, the higher the better. Normally, 3 or 4 is considered adequate. And that's why you'll hear people say, oh, your debt payments from your mortgage should be about 4 times. You should be able to earn about 4 times more than your debt payments from your mortgage, and so 3 or 4 times. So let's take a look at the times interest earned for Sprouts, and this is where you're going to find out that Piano, shut up. Sprouts is doing just fine. Okay, earnings before interest and taxes and interest expense. This is on the income statement. So let's go find the income statement. Here's the earnings before interest and taxes, $350,231, and we divide that by the interest expense, $6.491 million, and it turns out that Sprouts is doing just fine, dear students. Sprouts is earning their interest, how many times? 53.96 times a year. That means every week. Less than every week. They're earning their interest payments. Wouldn't you like to be earning every week your total mortgage payments for the entire year? Yeah, you would. and that's exactly what's going on with Sprouts right now. They have other problems. They have other things they have to worry about, other issues, the day-to-day operations. But they're doing all right, and that's why they are not worried about their debt payments. Thank you very much, Piano. We're not worried about our debt payments. They can certainly service their debt. Now, this one, total debt to total assets, again, it's going to look similar to something you learned in Business 121, Principles of Money Management. This is a measure of how much of the company's total assets have been financed by debts. You take the total liabilities and you divide it by the total assets. And so where is that? Total debt, total assets. It's on the balance sheet, of course. So I knew that. Where's the balance sheet? There's the balance sheet. So the total debt was, what is it? 2.178 billion, and the total assets 3.327 billion, and that's over 65%, 65.48%, which again, to me is a little scary, but to them, they ain't worried. Thank you very much. Go away, Piano. We're fine. We're doing just fine. Assuming people keep walking in the store, which people need to eat, and of course they will. Total debt to total assets includes both short-term and long-term debt and assets. If it varies substantially from the debt to equity ratio, the company may be relying heavily on short-term debt. A heavy reliance on short-term debt can denote more risk. Think of it as if you were using your credit card to fund your business, to get your business off the ground, which is what a lot of entrepreneurs do, right? Because they can't go to a bank, the bank is not interested, and their brothers and family and friend and sisters have said, no more, we can't. Yeah. But hopefully God bless them and they do well and become the next, next big thing, because we love those entrepreneurs. They are the ones who supercharge our economy. And then the final one is a little bit more complicated version of this, called total debt to capitalization. So we've got to do a few little calculations: the short-term debt plus the long-term debt divided by the short-term debt plus the long-term debt plus the shareholders' equity. This is a measure of the total amount of outstanding company debt as a percentage of the firm's total capitalization, similar to the total debt to total assets ratio. Thank you very much. As with the other debt ratios, the higher the debt level, the more risk of insolvency. However, some industries with high rates of debt, such as utilities, also have more reliable earnings. As always, we must compare our results with the competitors. I think I've said that right, in the industry as a whole. So I don't want to go through all the calculations, but it's you wind up with 57.67%. Make sure I did it right. Right, the numerator 164. This is all on the balance sheet, by the way. 164,887 short-term debt plus long-term debt is 1,399,676. That's the numerator. You get 1.564 billion. In the denominator, you get 164,887 plus 1,399,676 plus the equity, the shareholders' equity of 1,148,547. So that's a total of 2,713,110. And I'm talking quickly. Slow me down or pause if you check it. And you get about 57.67%, about 58%. So a little bit less than the total debt to total assets, but still in the same ballpark, more than 50%. And that, dear students, is our discussion of financial statements and ratio analysis. Dear, tell me about your day at work. It's important, yes. And speaking of accountants, she retired, oh, sad, we miss you, Professor Martinez Sanabria, who was a whiz at spreadsheets. She was an accounting instructor, and she just made the best spreadsheets. And I have this cheat sheet. In fact, I was thinking of putting it on the website. I think I should. That I just did just real quickly, just to make these calculations, so I didn't have to do them all by hand. And she took it one step further and made this gorgeous spreadsheet that did all these cute things. And I thought, wow, that's amazing. So she's pretty amazing. But we miss her. Okay, so what's next? Dear students, dear risen investment gurus, we have done the heavy work with regard to stocks. Yes, so we're going to ask you over and over again, go back and study chapter 3, go back and study chapter 4. Chapter 5 is pretty straightforward. In the assignment, we're going to ask you to do just 12 of these. Make sure you do 2 from each of the categories. Do 2 from the profitability, 2 from the liquidity, 2 from the solvency, and they're the same. Activity ratios, solvency and liquidity are the same. And look up 2 from the common ratios. Because once you've done it, 3 or 4 of them or 5 of them, you I got the idea. But now it's time for something completely different. And so the next 2 chapters are going to have a little bit of silliness in them in chapter 6 and a whole lot of silliness in chapter 7. So stick with us now as we switch gears from fundamental analysis and take a look at the efficient market theory, and then chapter 6, and then the true silliness of technical analysis. And that will be our long march, our long journey of stocks. Thank you so much for being in our class, dear students. We are so, so proud of you. Think of how much you have learned and how much more you have to go over and review it. I know. Some people, they're really lucky. They see it once, they hear it once, they read it once, boom, they've got it. I'm not one of them, and most of us in this world are not. So it bears repeating. Watch the presentations, read the book over again, do the worksheets, and be awesome. We are so proud of you. See you in our next chapter, Market Efficiency Theory. Who can beat the market?